Hi everyone, here is your video tutorial on 1-3 work together. I know we did this quickly at the end of class and I think some people, were missing. So hopefully this will help guide you through the on your own problem and the application problem. Although I haven't looked at the application problem yet, it might be completely different from this. Anyway, so here we have the an expanded accounting equation, and you can see under the asset section you have cash, and we have a new type of account called accounts receivable, and these are accounts receivables are set up for companies that you go ahead and perform services for, but they don't pay you cash at the time. So you set them up on account. So they owe you money. So they are considered an asset because at some point you will be receiving money from them. All right, that's a new account. Supplies is the same old asset that we've been talking about, and prepaid insurance, okay? And liabilities, over on the other side, we have one account payable and then the owner's equity and the owner's capital account, okay? So we're just going to put a plus if in a column if an account increases, and we'll put a minus in there if the account decreases. We talked a little bit this morning about how revenue increases capital. When you make a sale as a business owner, your net worth increases, so the capital account will increase when there is a sale. And we also talked about expenses. When expenses are paid, expenses are necessary to operate a business. When expenses are paid, cash decreases, and then also owner's equity will decrease, because when your cash balance is dropping a little bit, then you are temporarily having a drop in your net worth in your capital account, okay? So I'll go through this quickly so you can get on with your life, all right? Received cash from sales, that's the first one, received cash from sales. So the two accounts that are going to be affected right now, later on we are going to have a separate account for revenue, but for right now and for purposes of the accounting equation, received cash from sales, if you receive cash, that means cash is going up. So that's going to be an increase here. And when cash is increased from sales, you have an increase in your owner's capital account, okay? So revenue affects owner's equity because, by increasing it, all right? That's one of the transactions that affects owner's equity, revenue. Okay, so the second one is the same as the first one, except cash is not involved. It's another sale. So when you see a transaction that says sold services on account to Harmon Company, that means your business went out to Harmon Company, did whatever it is you do for them. Maybe you designed a website for them, and you're going to bill them because they didn't pay in cash for you. All right, so sold services on account. So when you sell services on account, you have to set that account up as an account receivable. So the account receivable in that transaction is going to increase because they didn't owe you any money before, but now they do owe you money. So there's an increase in their account. And because it's a sale, capital increases, your net worth increases, okay? I just want to make sure that you understand, even though you didn't get cash yet, you still record the sale. So when you see sold services on account, it's still revenue. Even though you didn't get even you haven't gotten the cash yet from the customer, it's still revenue. It's the same as when you go to a store and you use credit card. They ring you up and you get checked out. It's a sale for that store. Even though they haven't gotten the cash yet, it's still a sale for that store. So you still report the revenue at the time of the sale, even if it's a sale on account. Okay? All right, number 3, paid cash for the cell phone bill. Cell phone bill is an expense. So cash is going to go down if you're paying cash, and expenses temporarily decrease the owner's equity, the net worth in the business, okay? Because your cash is going down, so your net worth is going down. And number 4, received cash on account from Harmon Company. Now Harmon Company owes you money, and now they're paying you some money toward the balance that they owe you. So when you see the words received cash, that means cash is going up. So that is an increase here. And Harmon Company is the one who gave you that cash to be applied to their balance. So their balance now is going to be reduced. All right. So let's say, for example, they owed you $500 and now they paid you $200. So there is going to be a decrease in their account and their balance would be $300 after they pay you. Okay. All right, and then this last one, owner withdrew equity in the form of cash. If you missed class today, what we talked about was that when you own your own business, you're allowed to take money out of your own business for personal reasons. It's your business. And it's completely legal to do that. You just have to remember to record it. And it gets recorded in a separate account called the owner's drawing account, which we'll get to next chapter. But when owner withdrew equity in the form of cash, that's just a fancy way of saying the owner took money out of the business for personal reasons. Okay? So cash goes down because the owner took cash, maybe out of the cash register drawer, I don't know. So the owner took cash, and so cash is decreased, and then net worth is decreased as well. Okay? So that's that one. I'm going to stop this video now and take a look at 1-3 application problem and see if you need any help there.